I'm Gary Venner, CEO of IFA Acquisitions, and I'm joined by Anand Chandarana, Senior Tax Manager of Haines Watts, who are one of the top 15 chartered accountancy firms in the UK with over 50 local offices, where we continue our informative question and answer series on our YouTube channel to provide insights into helping buyers and sellers understand the benefits of using brokers for the purchase and sale of IFA businesses, and also from using accountants for sound tax planning advice. The title of the next video is coming up on the screen now. So if we look now, Anand, at limited companies, obviously one of the attractions of buying a limited company as an IFA is the ease and simplicity and not having to do the repapering, etc. However, for some acquirers, they would prefer an asset purchase because it's preventing them from taking over the past risk. And the issue with having an asset purchase is that those proceeds of sale goes into the limited company and are then charged at corporation tax.
Absolutely.
So what are the areas around this that can, is it still worth those business owners talking to qualified accountants like yourselves about how to do that structure? Is there ways around that they can actually get business asset disposal relief?
Yeah, again, great question. So, as you say, I mean, the traditional scenario is you have an acquirer, and from their point of view, they probably want to trade an asset sale for the reasons you've highlighted, that you don't take on the commercial risks of the previous limited company. And of course, from the seller's point of view, they almost want the opposite. It's like, sell my shares, it's much easier. As you say, you transpires that you get your business asset disposal relief because you're selling your shares. It's nice and simple. So in the case of a trade and asset sale, the vendor, whilst they won't get business asset disposal relief on the sale of the trade and assets because they don't own it, the company owns the trade and assets, the company pays corporation tax rates, and then the individual, if they want to extract the funds from the company, will then have their own personal capital gains tax to worry about. And at that point, if they liquidate the company to take out the proceeds, obviously net of the corporation tax that the company has paid on the sale of the trade and assets, that's when they can achieve business asset disposal relief, as long as they liquidate within 3 years of the trade ceasing.
Yeah, I understand, and I think a lot of people do forget that the business asset disposal relief is still available to actually extract those proceeds later down the line. But the corporation tax is something. But I guess also there are other areas that those the shareholders can also consider. Using pension contributions and things like that. Is this something that you get heavily involved with?
Oh, absolutely. Again, because we're in the owner-managed business space, these are the daily conversations we're having with our clients, ongoing businesses as well as people wanting to exit. So we're always talking to people about, should you have your salary dividend mix? What sort of level should that be? Because traditionally dividends tend to be cheaper on extraction. Pension contributions is also a fantastic example of a really tax and national insurance free exempt benefit. It's a really nice way to extract money from the business. Of course, there are annual allowance limits and lifetime limits, so it's not quite as straightforward as saying, well, I've got all this money, I'm going to take it all out and it's all going to go into my pension, because you're restricted into how much you can put each year. One of the other aspects which as you say, most people, when they sell their business, they sell their trade and assets, or the company sells the trade and assets rather, and they've got then the cash in the business left. Most people will say, okay, well, I want those proceeds, I want them straight away. Of course, if they don't have a need for them, they can stagger what they take out of the company. So some people may say, let's do that, and it's spreading the tax costs. Again, if you're going to go over 3 years, then you're going to lose your BADR above the 3 years, anything you take out above the 3 years. But equally, some people might say, I'll just take out my sort of basic rate band, if you like, which is coming up to 8.25% on dividends, which is cheaper than 10%.
Yes, absolutely.
Absolutely. So it depends on the what the objectives are of the individual, and that is it was why we always say to people, have a thought about or have a think about what you're trying to achieve here. You're going to sell your business, that's sort of hurdle one, but then what's next?
Yeah, and I suppose you would also talk about rollover relief and things like that, and other types of tax vehicles as well that those individuals may consider, I suppose, as well as
Exactly. And so the point there is, again, what are they going to do with the cash that's in the company afterwards? Because actually what we're seeing a lot more frequently with our clients nowadays is they've sold the business, cash is in the company, and actually that they just turn that company into an investment vehicle.
Yeah.
And so we're seeing a lot of, and basically when people do that, we call it family investment companies. And what a family investment company allows you to do is to essentially have gross roll-up in the company, especially if you're going to invest in a share portfolio, because listed dividends, basically corporates don't pay tax on them. So your money grows tax-free until you want to extract it. And again, the extraction policy is up to you and up to your family, because of course you can bring your family in as shareholders in the family investment company.
Just listening to you, Anand, it clearly, that I think in this situation must be to ask and get professional advice, and any fees for professional advice are, the return on that investment of those fees will be considerably, pay dividends, I think, here. It's just to know what is available, and every case, I guess, is bespoke as well, isn't it?
Exactly. Every case is bespoke. I mean, it's not something we've touched on before, but actually some people will say, I'm coming to retirement, I want to sell my business. We might say to them, why don't you move abroad to do that?
Wow.
Want to avoid your capital gains tax?
Yeah.
And of course, you'd have to pick a country which itself doesn't levy capital gains tax on disposals, and there are certain countries that don't do that. So there's a whole gamut of options available depending on how flexible someone wants to be, and again their objectives. We deal with a lot of clients who have come to the UK from the original country, the country of origin is somewhere else. They've come to the UK, they've built up a business here, and actually they might want to return to where they came from. They've got a wider family, and for them it might be really appropriate to sell and move back. And
it certainly sounds an area to investigate, and you'd be mad not to, wouldn't you? And also I'm guessing that it's not, don't leave it too late as well.
Exactly.
It's actually, we find as a broker that a lot of sellers come to us 2-3 years before they're ready to sell. This is really the time also to actually make sure that the accounting side is all in the right places, I guess.
Absolutely. Absolutely. As we've touched on BADR having a 2-year window if you've got some non-qualifying people that you want to make sure they qualify. So that's one of the areas that stands out. Equally, share options. So often, the sort of departing founder, if you like, they have been working with key staff members for a number of years. They want them to be looked after. Sometimes they'll say, actually, I want to put, for example, an enterprise management incentive scheme in for those employees, those key people, and that means they'll get some share of the proceeds when the company is sold. But again, you've got a 2-year window if you want, those individuals to get your business asset disposal relief. So there's a myriad of things that an individual would want to consider if they're thinking of selling their company, because there are plans you can put in place, and we've talked about also thinking about what are you going to do afterwards. Because that's key. You might want to just spend the money on a nice expensive yacht or any number of things.
We've seen lots of different ways that retiring IFAs have wanted to actually take their future as well. And it's great to know that for a lot of those, it's not just simple retirement. It really is to do something that they've always dreamed of doing. Exactly. So absolutely superb, fantastic. So then we're going to talk more about the tax treatment for acquirers now. How is the tax treatment different for an acquirer that actually purchases on an asset deal versus a share purchase?
Yeah, so from the buyer's point of view, if they buy the trading assets, that they would normally buy that and subsume that essentially into their existing group of companies. And from that point of view, they've made an acquisition, they've bought the goodwill. The goodwill, to basically you can't really write it off against your profits, and there's very limited relief that the government introduced a few years ago about goodwill. It's been a bit of a roller coaster, shall we say. Before you used to get your sort of write-off based on your accounting treatment, and then they stopped it, and they've introduced it to a limited extent. But for all intents and purposes, essentially your goodwill, you don't really get much tax relief on acquisition. So that's the tax consequences for the buyer for a trading asset purchase. For a share sale purchase, consequences there are you've bought a nice, I suppose, an ongoing trading vehicle. So again, you bring it, and it depends on how you buy the shares, what entity in your group buys the shares. Potentially I can see for some buyers it being quite attractive to buy a company as a subsidiary and to have that as a separate subsidiary within the group, rather than necessarily making it a subsidiary of another, like an intermediate holding company. So it all depends on what really the buyer is trying to achieve. But I would say that doing a share sale or share acquisition is more flexible for the buyer than a trading asset one.
And we certainly know that from some acquirers actually having a preference for share purchase, but of course, making sure that they're buying very vanilla businesses that have low risk, etc. But yeah, it can be a lot easier, and nothing gets lost as well from the trading income by doing so as well. So that's good. Make sure that you subscribe to our YouTube channel and switch on notifications so that you won't miss our next video in this series. We provide insight into the tax planning benefits for an exit or acquisition of financial advisory businesses, as well as the benefits of using brokers by two industry experts, me, Gary Venner, CEO of one of the UK's largest specialist brokers in IFA Acquisitions, and Anand Chandarana, Senior Tax Manager of Haines Watts, one of the UK's top 15 chartered accountancy firms.